Hi trader, this is Chris from Elite Currency with yet another video on Fibonacci. This time around I'll be discussing how Fibonacci can be used in multiple ways and in fact a great tool and very diverse. First of all though, please be aware that there is high risk involved with trading foreign exchange and other financial markets and products. Please seek the advice of an independent financial advisor for more information on that. This video and webinar is for educational and informational purposes only, and by continuing watching this webinar and video, you agree with this disclaimer. Alrighty, the ways we can use Fibonacci. First of all, of course, entries and exits, and we've discussed that a bit by looking at retracements and targets itself, but that will certainly be a topic that will be discussed in more detail soon. We're going to discuss actually today filters, basically using the Fibonacci tool as a way to filter out setups. And then later on also we'll take a look at opportunity, how to use the Fibs as opportunity and as a trigger. But first of all, as a filter. Now basically we can use Fibonacci and the Fibonacci levels as a way of spotting support and resistance. Not just any type of support or resistance, but in my opinion, very important major levels. So first of all, what is filtering out? Perhaps you're wondering, what does that mean? Well, basically, it is skipping a setup that would normally meet your requirements for a setup, normally meet the requirements that you have for a strategy, and you would typically enter a trade, but instead of entering, you don't, because in fact the fib is too close and you filter it out. That means you skip that particular setup, because in the long run, you don't expect this particular circumstances to be profitable for your trading. So basically this means skipping a trade setup because of less desirable factors on the chart. All right, and ultimately of course the filtering out process should help the bottom line or the profitability of traders, as we are then ignoring setups that do not offer that positive expectancy in the long term. And one of those reasons why I'm not taking a setup is because of Fibonacci. So the question is, why would I not take a setup? Well, in essence, as traders, we want to avoid trading close to major Fibonacci levels, simply because price could respect it, and I'm expecting it to be respected, and basically then turn on a dime into the opposite direction. All right, so here's an example of the pound dollar recently, where you can see price retracing back. Right, we had an uptrend here, the green arrow showing that, and price then slowly but surely, indicated by orange, going back, first stopping at 23.6, lightly stopping at the 38.2 fib, heading towards the 50, which ultimately was the turning spot for that upside. So the 50% fib here showing its importance for the market, and price indeed stopping there. So the idea of filtering out a setup would be that if I'm thinking about shorting the market right in front of the 50 fib, well, that would not have been a good idea, as you can see, because price turned around at that fib. So when I notice the 50 fib, when I identify it, I would then skip a short in the direction, towards right in front of the 50 fib, obviously because price turned around at that level, and I'm expecting it to do so. So that would have been a profitable decision. Nothing would have been lost on that short, and that of course is money made in a way, because otherwise if I take the short, I would have lost the pips. So the rule of thumb is quite simple. Basically, I'm not taking longs right in front of or before the resistance fibs, and I would then avoid taking shorts in front of support fibs, like the 50 fib example that I just showed. So I am expecting these fib levels to hold and be respected by the market, either by a big bounce, like the previous example was showing, or sometimes even smaller bounces and retracements that do not go all too far, but still a 50 or 70 pip bounce doesn't seem much maybe on a daily chart, but for intraday trading could certainly be very dangerous if trading against that. Now I do want to add that not necessarily all of these fibs will receive a big respect, sometimes not at all. But I am planning my trade assuming that price will respect each and every of my important fib levels, although I realize that not all of them will. I will not become discouraged if occasionally I miss a profitable setup because of this filtering process, because in the long run, it will help me. The last important question is, What is a major fib? What do I consider important when looking at the charts? Well, that might not come as a surprise, but obviously daily, weekly, and monthly charts are to be considered for critical levels. And those are certainly good time frames to consider and review and analyze. My personal typical approach, however, looks at the time frame chart, which is one time frame higher than my trend chart. So basically, what I do then is, for instance, I often judge the trend on the 4-hour chart for determining, what the trend is and if there's a reversal going on. And then I look one time frame higher on the daily chart to look for filters. If someone is using, for instance, a daily chart as the trend, then I would then in that case use the weekly as the filter chart. Now personally, I rather use one fib as a filter, max two, because if there are too many fibs from too many time frames, then obviously it gets confusing and there would not be any space at all because the whole chart will be filled with fibs. So I focus preferably on one, max two. Last but not least, when do I consider a setup to be not good anymore? When is the ratio not interesting anymore? And that is called the R2R, the reward to risk ratio. And what I do basically is I look at what is the optimal stop loss, what is the optimal target in comparison to the fib level. So in this case, the 50 fib was optimal target, right? Because the chances the price will bounce there are decent. Now, for instance, if the entry would have been here at orange, then I can calculate what the size of the reward is compared to comparing the target to the entry, which is this green box. I can then compare the size of the risk compared to the entry, which is this light red box. And then I can compare the green and the red boxes and see if that makes sense. Now, if it's less than 1-to-1, the trade is becoming a bit doubtful because there's less risk, or more risk actually than reward, and that is something that is not as desirable. If there's more reward involved, then that's a good thing. Now, I'm not saying that necessarily less than 1-to-1 is out of the box, out of the window for sure, but if it's less than 0.7, then it's certainly becoming less desirable. Obviously, 1-to-1 or more is pleasant, because if you look at these boxes, in this case, obviously it's way less than 0.7. The reward box is just so small compared to the risk that why take that risk to earn so little? In the long run, a couple of losing trades would wipe away all of the wins, and that's just not sustainable in the long run. So that explains the Fibonacci filtering process. Next videos, we're going to take a look at opportunity, trigger, and entries. Make sure to send an email, and you'll get a free ebook on Fibonacci, trading psychology, or Camarilla sent to your email. Thanks for joining, and wish you good trading. Cheers.